The market is flashing warning signs, signs we haven't seen in years. Over the past 11 weeks, the 10-year Treasury note has dropped 65 basis points. That's a massive move in such a short period of time, signaling deep uncertainty among investors. But here's the real kicker: inflation is still rising. This isn't just unusual, it's historically rare. When interest rates fall and inflation continues to climb, it suggests that the bond market sees trouble ahead, even if the broader public doesn't. So what's really happening under the surface? What does this mean for you as an investor, saver, or even just a regular consumer trying to protect your income? In this video, we're going to break it all down. We'll explore the deeper economic signals, how trade, tariffs, and policy shifts are influencing markets, and most importantly, how to position yourself not only to weather the storm, but to come out ahead. Make sure to like this video and subscribe for weekly insights on how to navigate today's economy and markets. Now let's jump in. To understand where we are, we need to look at how we got here. If we rewind to the early days of the US-China trade war, we saw very similar market dynamics. The S&P 500 hit a peak, then started retreating. The US announced rounds of escalating tariffs. One of the most notable examples was a 25% tariff on autos. As soon as that policy was announced, bond yields began to fall, indicating investors were expecting slower and slower economic growth. Why? Because tariffs act like taxes on trade. When companies are forced to pay more for parts, materials, or finished goods, those costs are often passed on to consumers, and that hurts spending power. Here are 3 key ripple effects we saw then, and some similar ripple effects we're seeing now. Number 1, higher consumer prices. From electronics to clothing, many everyday goods become more expensive under a tariff regime. Inflation starts to rise in areas where it hurts the most: at the grocery store, at the gas pump. Supply chain disruptions. Many businesses, especially in manufacturing and tech, operate on global supply chains. When a tariff is slapped on a key component, companies often find themselves scrambling to find alternatives, often at higher cost and lower efficiency. Corporate uncertainty. CEOs and CFOs hate uncertainty. When policy becomes unpredictable, they back out of hiring, investment, innovation, on and on. All this leads to slower economic growth. One often overlooked point is how tariffs distort incentives. Businesses may start sourcing from less efficient suppliers just to avoid the tariffs. This hurts productivity over the long term, and it can also lead to retaliatory tariffs from other nations in the short term, squeezing exporters and manufacturers. So when the bond market starts to signal a recession, it's often because investors saw these knock-on effects stacking up, and the same pattern is emerging today. Let's talk about the big 3 economic indicators that are now flashing red: bonds, oil, and gold. First, the bond market. This is the most reliable recession indicator in the financial world. When the yield on long-term government bonds drops below the yield on short-term bonds, it's called the inverted yield curve. Historically, this has predicted every US recession over the past 50 years, and we've seen an inverted yield curve for several months now. Moreover, when the Fed begins cutting interest rates in the middle of an economic cycle, it's often because the data behind the scenes, consumer spending, manufacturing activity, and employment, is weakening. In 2024, the Fed began cutting rates after inflation showed signs of moderating, but the market didn't react with a rally. Instead, the S&P 500 pulled back, which tells us investors are bracing for an earnings slowdown or even an economic recession. Next, oil prices. Since the latest round of trade tensions emerged, oil has dropped over 20%. Why is this important? Because oil is demand sensitive. If economies are strong and expanding, people travel more, goods are shipped more frequently, and manufacturing uses more energy. A sharp drop in oil means global demand is cooling. And finally, gold. Since October 2023, gold has surged 70% and hit over 50 all-time highs in a single year. That has only ever happened during periods of major financial distress. Gold is a fear trade. It doesn't pay interest or dividends. So when people rush to gold, it's because they want safety, not growth. Here's an added layer. Central banks around the world have been increasing their gold reserves, including emerging markets like India and China. That suggests even governments are hedging against potential instability in the global financial system. Let's talk about GDP. The Atlanta Fed's latest forecast for Q1 2025 GDP was just revised down to negative 0.5%. But that's just the headline number. When we account for the impact of trade flows and real inventory adjustments, the actual growth could be closer to negative 2.8%. That would mark the first official contraction since 2022. Why does this matter? Because recessions are technically defined as 2 consecutive quarters of negative GDP growth. If Q2 follows suit, we're officially in a recession. Now, GDP isn't just an academic number. It affects real lives. It influences whether businesses can hire and fire, whether wages go up or remain stagnant, whether people can afford homes, healthcare, and education. When GDP contracts, it also always shows up in rising unemployment. Let's zoom in on the labor market. Jobless claims are slowly ticking up, wage growth is decelerating, and sectors like tech, finance, real estate, which have led to economic expansion, are now showing signs of retraction. Consumer sentiment is already reflecting that. The University of Michigan's Consumer Sentiment Index has cratered to its lowest point since 2022. When people are worried, they spend less, travel less, and take fewer financial risks. Add in global uncertainty, China's manufacturing slowdown, Europe's persistent inflation problems, and you get a global growth picture that is far from optimistic. So what can you do? How do you turn this uncertainty into an opportunity? Let's start with the defense. Gold and silver. These have been reliable stores of value in downturns. Gold has been soaring, but silver, often lagging behind, might still offer some upside. Treasury bonds and short-term government debt. As interest rates fall, bond prices typically rise. Long-term treasuries could benefit significantly. Defensive stocks, think healthcare, consumer staples, utilities. These companies tend to perform well even when consumers cut back because their products are essential. But there's also room for smart offense. Look for undervalued growth stocks. When the markets pull back, great companies go on sale. This is where you want to do your research and look for long-term winners. Emerging markets. Some economies may actually benefit from global realignments in trade and supply chains. Countries like India, Vietnam, and Brazil are showing strong fundamentals. Alternative assets, real estate, private equity, and even collectibles are increasingly being considered by investors looking to diversify beyond traditional stocks and bonds. But whatever your approach, you need a framework, and that starts with knowing your time horizon, your risk tolerance, and your financial goals. Let's break down some actionable strategies you can start with using today. Number one, reassess your risk tolerance. In good times, it's easy to take on too much risk, but now it's time to rebalance and reduce exposure to highly speculative investments. Build cash reserves. Having 6 to 12 months of expenses in cash gives you options. If the job market weakens or your income dips, you'll be able to weather the storm. Invest in quality over hype. Forget the latest meme stocks or speculative crypto. Look for companies with the real earnings, strong leadership, and durable demand. Dollar cost average. If the market continues to decline, investing a fixed amount on a regular schedule helps you buy more shares at lower prices. Stay informed and adaptable. Subscribe to trusted economic newsletters. Watch Fed's statement. Learn how to read a balance sheet. The more informed you are, the better your decisions will be. Don't overlook tax strategy. Use downturns to your advantage. Consider tax loss harvesting, Roth conversions, or maxing out your retirement accounts. When valuations are low, consider dividend-paying stocks. These provide income even when prices are volatile. They can be a stabilizing force in your portfolio. Now let's pull everything together with a few final thoughts. Markets are cyclical. Every boom is followed by a correction. Every correction eventually ends and the recovery starts. Trying to time it perfectly is nearly impossible. What you can do is prepare. The Fed is not your savior. While rate cuts may soften the blow, they are not a silver bullet. Monetary policy can't fix broken supply chains, geopolitical instability, or overvalued asset bubbles. Stay diversified. Don't put all your eggs in one basket. Diversification is still one of the best tools to manage risk without sacrificing opportunity. Think global. The US may be the largest market, but it's not the only market. Diversifying internationally can expose you to new growth trends and reduce country-specific risk. Avoid emotional decisions. Fear and greed are the biggest destroyers of wealth. Stick to your plan. If you don't have one now, it's time to build it. So where does this leave us? We're standing at a crossroads. On one path, the economy could stabilize, inflation could ease, and markets could recover. On the other path, we face a deeper recession, more layoffs, weaker earnings, continued market volatility. But either way, there are steps you can take to protect and grow your wealth. Economic cycles are part of the natural rhyme of markets. What matters most is your ability to think long-term, stay disciplined, and prepare when others are panicking. Let me leave you with this. Markets are emotional, but you don't have to be. The more data, history, and context you can arm yourself with, the less likely you are to make short-sighted decisions. If this video helped you better understand what's happening in the markets, be sure to like and subscribe, drop a comment with your thoughts or questions, and let me know what you're seeing in your corner of the economy. Thanks for watching. I hope to see you in the next one.